All right, today we're diving deep into the third quarter 2025 earnings for installed building products, that's ticker IBP. Now, on the surface, the company posted some incredible, record-breaking numbers, but the stock, it kind of just fizzled out. So we're going to unpack this really interesting conflict that came up on their earnings call, a booming commercial business that's fighting tooth and nail against a really tough housing market. Let's get right into it.
And that's really the million-dollar question here, isn't it? IBP delivered results that just absolutely crushed expectations, yet the stock did this little pop-and-fade move. So why did all that initial excitement just cool off? We're going to dig into the details that made investors pump the brakes.
So first things first, let's look at the headline numbers. Because honestly, on paper, they were just fantastic. No two ways about it. Management came out swinging with record sales and record profits, which set a really positive tone right from the start.
Let's start with the bottom line, with profits. The company delivered an adjusted earnings per share of $3.18. And look, this wasn't just a solid number, it was a brand new record for the company.
So just how good was that? Well, it was a full 18% above what the analysts on Wall Street were predicting. They were looking for about $2.69. I mean, that is a massive surprise to the upside. So from a pure profitability standpoint, IBP absolutely knocked it out of the park.
Okay, so what about the top line, the sales numbers? Well, the story there was just as strong. Revenue for the third quarter clocked in at a record $778.2 million.
And that was also a really nice beat, coming in about 5% ahead of Wall Street's forecast. So you're looking at this, right? Strong results on revenue, even stronger results on profits. So why wasn't the market throwing a party? To get that, we've got to look behind the curtain.
Yeah, because the story behind the numbers reveals this huge split in the business. There's incredible strength in one part of the company, but it's masking some pretty serious challenges in another. And that's what investors started to zero in on.
This slide right here, this tells the whole story. It's like a tale of two different markets. If you look at same branch sales, that's a great way to compare apples to apples. You see the split. On the left, their heavy commercial business was on fire, up over 30%, thanks to these big projects. But then you look to the right, the new single-family home business, which is IBP's bread and butter, it was actually down 2%. And that right there is the core tension for this company right now.
And you don't have to take my word for it. The CEO, Jeff Edwards, he was very direct on the call. He pointed his fingers squarely at housing affordability. He said it's the #1 headwind. I mean, even with interest rates coming down a little, the all-in cost of a new house is still just a massive hurdle, especially for first-time buyers.
Now, one thing that kind of helped soften that blow from the weak housing market was IBP's geography. See, they have a really strong presence in the Midwest and the Northeast, and those regions actually saw a little bit of growth. That helped balance out a flat South and a declining West where those affordability problems are really hitting the hardest, especially since those areas saw prices just skyrocket after the pandemic. So you have this really tricky environment with a struggling housing market. The big question is, what's management's game plan? How are they creating value for shareholders through all this? Well, they laid out a super clear, very disciplined playbook on their call.
They're basically hitting it from three different angles. First, they're sticking to their M&A strategy. That means they're buying up smaller local competitors, and that's already added over $58 million in annual revenue this year. Second, they're handing cash right back to shareholders through a dividend that keeps on growing. And third, they got really aggressive with buying back their own stock, scooping up over $51 million worth in the third quarter alone. They clearly think it's a good investment.
And what's really impressive is that this whole strategy is backed up by just fantastic execution on the ground. Think about it. Even with less volume in the housing part of their business, they actually managed to expand their adjusted EBITDA margin to a best-in-class 18%. That just screams excellent cost control and smart pricing, even when the market is tough. Okay, so this brings us full circle, right back to the stock price. With such great execution and a massive earnings beat, why did the stock fade? Well, it all comes down to what management said about the future and what that means for the next few quarters. Let's just replay the tape from earnings day. The stock shot up almost 7% before the market even opened, all thanks to those great headline numbers. It kept running up to a high of $270 during the conference call, but then it started to reverse, giving back about half of those gains to close up just a little over 3%. So what happened? What put a damper on the party? It really boiled down to three key things from the call. First, management said they expect a pretty significant volume drop from their big home builder customers in the fourth quarter. Second, they basically said any real recovery in the multifamily apartment market isn't happening in 2025 anymore. It's been pushed out to late 2026. And finally, you have the analysts, and most of them are still pretty cautious, with hold ratings and price targets that don't suggest much more upside from here.
So, let's put all the pieces together. What does all this mean for the next quarter and maybe even beyond that? Here's the Talk Ticker's take.
Our models are pointing to Q4 earnings somewhere around $2.35, which lines up with that cautious tone from management. And given these really strong but opposing forces, strong commercial versus weak housing, we expect the stock is going to get stuck in a rut for a while, just consolidating sideways. For that reason, we're initiating coverage with a market perform rating. The company's execution is amazing, but it seems like that's already baked into the price, at least until the housing market really starts to show signs of life again.
And that really is the key question for anyone looking at this stock as we head into 2026. IBP has proven, time and again, that they can execute flawlessly. The debate now is whether that amazing execution is enough to push the stock higher while its biggest market is facing these huge structural headwinds from affordability. That's what you have to decide.
And as always, just a quick reminder that this is for informational purposes only. It is not financial advice.